I remember a meeting early in my career as a financial planner when one of the top advisors in the country wanted to meet with me, which was awesome. You have a chance to meet with one of the top people in your field. Are you kidding me? I was stoked. And so we're talking, having a lot of fun, when he, out of the blue, surprises me and offers me a job. And he tells me that I can learn how things work. He said, I have the recipe, the clear recipe for success, and you can learn it from me. And I replied, because I was young and cocky, I replied that the fun of life was putting the business together and learning the recipe myself, figuring out which pieces really went where. That was the fun, and I'd internalize it that way. If I worked for him, I wouldn't internalize it. So thank you very much, but I'm good. But was I right? Is life all about learning the recipe yourself? Spoiler, kids, take the recipe from somebody who already knows how the game works. Live from the 3-room apartment above Uncle Jack's garage. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. Big week coming up for me, by the way. As you're listening to this, I am closing on the new basement in Detroit. Mom and I going to sign on the dotted line, and Mom's basement alive and well in the Metro Detroit area. Well, I'll be back here for a month, but then in January, we'll be in Detroit. But anyway, enough about that. Welcome to Money in the Morning. Money in the Morning is a show where we take not one, but two headlines and talk about what they mean for your wallet. And then we get super crazy and we take the ideas from both of those, we combine them and send you home with something called the big idea. And that's at the end of every show here. Money in the Morning is brought to you by Tiller. Tiller's your finances automatically updated in Google Sheets and Excel. Each day you pick Google Sheets or Excel. Tiller customers are more aware of where their money is going. I use Tiller, absolutely love it. Mom uses Tiller, she loves it. I like it simple, she likes it complex. No matter how you like tracking your money, stackingbenjamins.com/Tiller for more. All right. That's enough of Tiller. We got some great stuff for you today. So why don't we get this party started, huh? Laura, why don't you kick this thing off for us?
Good morning. You supply the coffee. We'll bring the headlines. Here they come.
It seems like a fair trade, doesn't it? You supply the coffee. We'll supply headlines. So let's do our job and let's get the headline out there. This first piece comes from USA Today and is written by Lacey Glover. Why you should think twice before paying for accident forgiveness on your car insurance. You see this thing all the time on television commercials, print commercials, radio, like accident forgiveness coverage. Sounds awesome. But seriously, sounds fantastic. And I didn't know very much about accident forgiveness coverage. And so I thought that, let's read and find out together. Lacey writes, if you pay extra for accident forgiveness for your car insurance, you might think your premium won't go up if you cause a crash, but don't bet on it. It's not quite that simple. With accident forgiveness, insurers say they won't raise your rate solely due to an at-fault accident claim. Some offer it as a free loyalty perk for long-term customers with clean records, while others make it an optional add-on you can purchase to put your mind at ease. In either case, a clean driving record for 3 to 5 years is required, so only those who tend not to cause accidents are eligible to pay for the perk. And that's the crux of it. How much do you want to pay for a mistake you haven't made and might never make? Here's how to weigh whether it's worth the extra cost. Premium increases versus the cost of forgiveness. First, it helps to know what's at stake if you don't have accident forgiveness and you cause a crash. USA Today analyzed NerdWallet analyzed 2018 insurance quotes nationwide to determine how much more drivers with one at-fault crash on their records pay compared with accident-free drivers. Rates and surcharges vary widely among insurers, but on average, the difference in premiums was $566 per year, or a 44% increase in insurance cost after causing a crash. That additional charges stick around for 3 to 5 years, depending on the company, so forgiveness can be appealing. But how much does it cost? In a separate analysis from 2017, among carriers who charge for accident forgiveness, it often costs drivers an additional 2% to 9%, though it varies significantly by state and insurer. That may not seem like much, but if you drive for several years without an accident, it can add up. And say you did cause a wreck, you wouldn't necessarily avoid a premium hike. Any good driver or claims-free discounts, which tend to range from 10% to 40%, could go out the window. What's more, car insurance rates are trending up overall, so many drivers are seeing premium increases without any dings on the record. Between September 2017 and September 2018, car insurance costs rose 6.6%, according to the Bureau of Labor Statistics. Quote, "If you want accident forgiveness, you'll pay for it in some way," said Kyle Nakatsuji, CEO of auto insurance startup ClearCover, based in Chicago. Even with companies that don't charge for it, the cost is typically already baked into your insurance rates. For drivers in California, accident forgiveness isn't an option because it's difficult for insurance to clear it with state insurance departments. According to Nancy Kincaid, press secretary for the California Insurance Commissioner's Office, insurers proposing to offer accident forgiveness would undergo heightened scrutiny. Why? By charging for the perk, insurers are in essence charging a customer for accidents that haven't happened yet, said Nakatsuji. Interesting stuff. Accident insurance. I'm wondering who watching maybe has accident insurance coverage as part of their coverage. So like anything in life, this is an add-on. It's a rider, as they call it in insurance. A rider is a piece that's not a piece of the initial coverage. It actually is tacked on. And with that tack on, you get some extra stuff. In this case, accident forgiveness. And the cost of an accident can raise your premium 40%. That's a big cost that you can forego. The quiz question is around the law of large numbers. And in the case of the law of large numbers, the insurance company knows they're probably going to win. For you, it's not so easy because you're not working with a large number. Let's talk about exactly what I mean here. An insurance company can offer something like accident forgiveness. They tack on a little more premium. They give you this additional benefit. And what happens is over the long period of time, they end up winning because fewer people have accidents than who pay for accident forgiveness. To even be eligible, you have to have not had an accident for 3 to 5 years already. So it's probably already better drivers on the road. The worst part of the pool is already going to be gone. So 3 to 5 years and longer, and you're actually eligible for it. Those people take it. Then what happens is an actuary applies the law of large numbers, and much like Las Vegas does this, where they have a 50.5% chance of winning and you have a 49.5% chance of winning, they have this slim margin where they know that they win over time. So for them, they can offer it, and sounds really cool, sounds awesome, and they end up making money. For you, you don't have a large number. You've got a number of exactly 1. So the first thing to do when it comes to accident forgiveness, if you're considering accident forgiveness, is know yourself. If you've gotten through the last 3 to 5 years without an accident, and everybody tells you you're a horrible driver, right? There's just some people who just know you're not a very good driver. For you, maybe accident forgiveness coverage makes sense. For a lot of people, though, if you've never had an accident, and I understand, by the way, that the accidents aren't always, and this is the tough part of this equation, and this is why it's not simple math, is that a lot of the time the accident isn't your fault. I just saw a horrible accident with a bus and a dump truck that was horrible. That was clearly one of the driver's fault. The other driver, all of a sudden there's a car there. And what do? Very difficult. In fact, I think of the accidents that I've been in. A snowplow just ran into me. I mean, I'm in a parked car and a snowplow comes barreling toward me, and all of a sudden I realize he's not stopping. So I put the car in drive. I try to get away. He still slams into me. Another time, I'm in a pack of cars in a highway, an icy highway, and I'm sitting at the back of the pack of cars. Once again, not moving. Look in my rearview mirror, car barreling toward me. I almost made it out of the way before he slammed into me. But still not my fault. Accident forgiveness could have helped on that side. Accident forgiveness could have helped on that side, but didn't help at all. But when it comes to having an accident, who knows? So because your number is 1, I don't know. But that brings up a bigger question, which is this idea of riders in the first place. When you look at insurance, there's a couple things that you want to do. Number 1 is ask the agent, the rep, whoever from the insurance company, what discounts there are that you can be eligible for. The great thing about an agent supposedly is that an agent can help you with discounts, yet often agents don't tell you what all the discounts are. Have them tell you every single discount that is available, because you might be able to get the accident insurance back. Or excuse me, you might be able to get a cheaper rate on your insurance. I'm trying to read and talk at the same time, which is not something that I do very well. That's number 1. But number 2 is ask them what riders come with it. Accident forgiveness is just one rider. There are many other riders. Eric is here hanging out with us. We do these live on Facebook, and he says that he added full glass coverage. Maureen is here. Maureen says she didn't add anything. She said she raised her deductibles recently, which took her premium down. I'm less likely to make a claim with a high deductible. Eric also says, we also had our coverage jacked up last year. I shopped around and saved 50%, 50. That's a monster number. Kimberly weighs in and says, accident forgiveness may be helpful for younger drivers or maybe in a bigger city with more drivers. I probably wouldn't buy it though. It's a difficult thing, but it's not the sure win that I think some people think it is. I think definitely whenever there's a rider added onto a policy, it's a difficult call whether to buy it or not. Know yourself. But anyway, ask for all the riders. What riders are available? Check all those off. And don't think, maybe I need this one. Think that this particular rider might apply to my very particular situation. Good stuff. First headline, accident forgiveness insurance. Let's move on to our second piece, which comes to us from CNBC. This was disturbing. Student loans. You know what's driving me crazy? Reading about people with student loans, with people that are senior citizens with student loans that they've had for forever, and more you're seeing people in their 50s and in their 60s that have student loans. It's very sad. This piece written by Carmen Reinecke. A teacher defaulted on $55,000 in student debt. Loan rehabilitation offered hope, but now he owes $130,000. How about that? He owed $55,000 when he defaulted. He now is $130,000. Let's read. 2014, Scott Naylor, a high school English teacher from Scarborough, Maine, went more than 270 days without making a payment on his student loans and so ended up in default. Naylor couldn't keep up with his loan payments while balancing other kinds of debt and providing for his family. So in addition to defaulting, he and his wife filed for bankruptcy. Naylor struggled to keep up with his debt since 2000 when he graduated from college, owing $35,000. When he stopped making payments over a decade later, his balance had swelled to $55,000, thanks to continually accruing interest. After he defaulted, Naylor decided rehabilitating his loans was the best way to get back on track. Federal student loans in default are eligible for rehabilitation, a process that restores loans to good standing after 9 monthly payments to a collection agency contracted by the Department of Education. So 9 months, he's got to pay a collection agency. And then after that, he's back on track. Student loan rehabilitation programs are one way for borrowers to move forward with repaying after defaulting on federal student loans. But many borrowers don't fully understand the risks, experts say. Since rehabilitation can add a significant amount of money to your balance, the drawbacks can outweigh the benefits and even put borrowers at risk of defaulting again. Though Naylor successfully completed rehabilitation later in 2014 and has continued to make regular payments, He now owes $130,000 because of the interest and fees for his specific combination of federal direct loans and federal family education loans. The debt feels like a problem he'll never be able to solve. While I'm able to keep my credit from the sewer, there's no way to pay it off, Naylor tells CNBC's Make It. Today, more than 44.5 million people collectively owe $1.5 trillion in student loan debt, according to the Federal Reserve. While the majority of debtors owe between $25,000 and $50,000, about 600,000 people owe more than $200,000. In 2015, over 10% of borrowers in a loan repayment program defaulted within 3 years, according to recent data from the Department of Education. By 2023, nearly 40% of borrowers may default, according to the Brookings Institution. By 2023, I'm going to read this again, nearly 40% of borrowers may default. That's thanks to, quote, the low earnings of dropout and for-profit students who have high rates of default, even on relatively small debts, Brookings reports. The fact that tuition has gone up while wage haven't contributes also. Defaulting on a student loan damages your credit score, which can affect your ability to secure a credit card, get other loans, and buy a house or a car. Borrowers in default cannot take out more student loans or pick a repayment plan. The government, through the Department of Labor or the Treasury Offset Program, can also garnish your wages, tax refunds, and federal benefits to pay off the loan. And there's a chart here that shows a $10,000 loan with 6% compounding interest, how it grows over a decade. A $10,000 loan, 10 years, $16,894.79. Naylor files paperwork, let's read that correctly, Joe, every year to stay on a repayment plan that keeps monthly payments manageable and less than what he used to pay. He says he now pays about $530 a month, which doesn't cover the interest on the loans. This means that even though he's making payments, his balance continues to grow. The total of $130,000 he now owes is twice his annual salary after 18 years of teaching and nearly $100,000 more than his initial balance. It's kind of like throwing money into a black hole, Naylor says. Some borrowers choose rehabilitation as a way out of default because after the mandatory payments are completed, the defaulted loan, though not in delinquency, is erased from your credit report. Rehabilitation might be a decent option for borrowers who'd have good credit, if not for their student loan default, says Ben Miller, Senior Director for Post-Secondary Education at the Center for American Progress. But it's a riskier option for others who are in a more economically precarious position. A third of borrowers who have rehabilitated loans will default again, according to a 2016 Consumer Finance Protection Bureau report. An update to the report in 2017 said that borrowers who were not enrolled in an income-driven repayment plan, which sends monthly student loan payments at an amount intended to be affordable, were 5 times more likely to default a second time. Once again, if you're not in an income-driven repayment plan, which sets monthly student loan payments at an amount intended to be affordable, you were 5 times more likely to default a second time. This may be due to fees added in rehabilitation, which include the cost of placing the loan with a private collection agency, as well as processing fees and attorney fees from the Department of Justice. These vary depending on the type and age of the loan, but can be 15.2% to 40%. Those are some big numbers. The piece goes on. I will link to this in my Twitter feed, Average Joe Money. This is a difficult thing. So you think you're doing the right thing by rehabilitating your loans, and yet you go from $55,000 to $130,000. When he says it's like throwing money into a black hole, the answer is yes. It absolutely is like throwing money into a black hole. Which is why when we start to ask the question, okay, what do we do with this? In fact, when I looked at this piece, I thought this is horrible. And I thought, what do we do with this? The answer, sadly, is very simple and incredibly ugly. You can't get into that situation in the first place. I remember working with some families and realizing that they had pinched every dollar to the bone. They came to see me because of the fact that they just didn't have any money. And they pinched every dollar to the bone. And I believed them. I didn't follow them around every day, but I believed them because you could see the amount of money they made. You could see the way money went out. They were very honest about the fact that they're losing money all the time. They're not really sure how they can actually get out of the black hole. And at some point, it became an income problem. And it was so very frustrating to have to tell somebody that. You've done all the right things on the expense side, but at this point, you have to make more money to get out of this hole. And in this case, it probably is an income problem if he's ever going to solve this hole. But the better solution is one he can't get back, which is not even getting there in the first place. Taking out those loans in the first place has to be, and I get the value of an education. Listen, I'm an English major, so I get the fact that there are some majors out there that don't directly lead to a career, but there should be. If you're taking out debt, there has to be an ROI. In fact, it's funny, in our basement Facebook group, somebody asked about going back to school and about the high cost of school. And I thought it was great how the members of the community said, if you're not going into debt, then it's a personal goal to get this education done. So if it's your goal, go do it. But going into debt to do it is a whole different thing. There has to be some ROI decision-making done there. At the very least, going to the Bureau of Labor Statistics to see what jobs are out there. I did this, and this wasn't a debt situation, but I did this with both of my kids when they were in college and were choosing a major. My daughter was choosing between going into pre-med or going into journalism. And when we looked at both of those, the pre-med programs obviously led to a whole secondary degree system that had nothing to do with Cheryl and I. We weren't going to pay for anything over the first 4 years, so there's going to be a lot of debt attached. But you look at those starting salaries for people in medicine and the degree to which we're going to need more people in the medical field, lots and lots of possibilities there. On the other side, when you take a look at journalism, some of the most passionate people I know, people doing some absolutely great work, working long hours, but beginning journalism degree people earning between $30,000 and $40,000 a year versus starting off well over six figures. And so my daughter decided that she was going to pursue her passion in writing as a secondary thing, do that in her spare time. She starts off in pre-med and absolutely hates it and has a horrible time in all the pre-med programs. And what was cool was that when she changed over to advertising public relations, when she changed over to that, she said, I know how much it's going to earn. I know where I'm at. I'm very comfortable with the fact I'm going to have to work my butt off for a lot less money. And she's doing great. But going in with your eyes completely open, I think gives you the ability then to have a strategy. And you know what? And for some people, and there's this idea in many places of the earth outside the United States, which is this idea of a gap year, learning why you're in college. When I've gone back to college to take classes, my grades have been way better than when I was first in college because I knew why I was there. I knew what I wanted. And when I interview people that have gone back to school to get a degree after a few years away, great grades, laser focus, know what they're looking for. And I'm not saying any of this, by the way, about this poor gentleman who has $55,000 in student debt to $130,000 in student debt. $55,000 in student debt to become a teacher versus a national average is at 40. Okay, he took out a little more debt than the average person. 40% roughly more debt than the average person did. So maybe that 15,000 a lot more debt. But my point is that for him, that 270 days where he didn't pay any of his bills and then declare bankruptcy was incredibly difficult. And then this is like a nail on the coffin. And you just don't want to get to that point. For him, if I was his financial planner, it would have to be just about more income. I can't think of another way out of this. Let's say hi, see what everybody out in Facebook land hanging out with us thinks about this. Tim says, it should be a crime to sell people student loans they can't pay. I don't know who's more responsible, universities that base their tuition on what people will be able to borrow, or the lenders who must see that these mountains are sometimes nearly insurmountable. Yeah, the idea, when you look at the statistics, Sheila Bair, the former FDIC chairman, when she was on the show and she was talking, Tim, to us about the student loan problem, she was talking about not to take the blame off of not-for-profit universities and state colleges, and private colleges, but for-profit colleges. When you take a look at them versus everybody else, there clearly is one set of colleges that is that's doing a lot worse for students than others. However, the system itself, in general, is absolutely horrible because there's free money out there, right? Free money with these federally backed student loans means, hey, I know that the cash is out there. Makes it real easy for universities to continue to raise the bar. Deanna says most IRS installment agreements default within 4 years. That's ugly. Tim says, why won't schools teach children how debt works? That's the $1 billion question, Tim. We need Tim. Tim for president. Tim 2020. There it is. Nadia says, hey, Nadia, says, we never had student loans, just worked our way through school slowly. That's it took me 7 years to get my bachelor's, Nadia, because I did exactly the same thing. I had a little bit of student debt, but it was funny. That was early in my career as a student, and I used a lot of my student loan money to go buy a computer. And I didn't buy a computer, by the way. I bought a computer ostensibly to do my homework. I was really buying a computer so I could play some video games. It was absolutely horrible use of money. I knew myself. I then decided, you know what? No more debt for Joe. That was just absolutely killing me. Eric says, I think a liberal arts degree is great preparation for lots of careers that require analysis, writing, and communicating. I worry that we might overly focus on beginning degrees that are only preparation for a specific job that might or might not help with future career goals. Man, I totally agree, Eric. I think that my degree in English, a great first round for somebody with a pre-law program, let's say, or if I'm not going into a lot of debt with an English degree, then being able to go out in the working world, get a 101 job, and then come back and expand upon that because I like my degree. Shireen and Paul are here. World travel is an amazing education and growing experience for students. The gap year, I couldn't agree with that more. I love the idea of the gap year that so many countries embrace, and our culture does not embrace it at all. We go right into college, and study after study shows that's not great. Deanna says, we're contemplating a gap year. However, stats are that if they stay in school, they're a lot more likely to complete. I just don't want my kid wasting her time getting an education she'll never use. Yeah, that's it's difficult to decide. I mean, this is as much know yourself as the first headline was, isn't it? About accident forgiveness. So much to do with so much. Kimberly says, my advertising and PR degree with a minor in graphic design has been great. I freelance and do all the marketing for my family side hustles. It'll be very helpful if she decides to start a business in the future. It's so funny. She now is looking at lots of different opportunities and different options, and she's become incredibly entrepreneurial. But I think, Kimberly, the reason she's opportunistic and entrepreneurial is because of that conversation that we said, if you have a degree like this, you're going to need to be. You're going to want to be, and you're going to need to be. And that's where her spirit is. I mean, she's rocking 18 months out of college, but really doing some great stuff. We're going to do something we call the big idea here in just a second. That's where we take both of these headlines and have one big idea to send you home with today. But first, I want to talk a little bit about our sponsor, Tiller, because I have been checking out a lot of the different Tiller templates. And Tiller has a slew of templates depending on what you're looking for. If you're somebody who's looking to set up a values-based budget, they have a template that Carl Richards, New York Times writer and financial planner Carl Richards, helped them develop. They also have one that focuses on different consumer items by consumer products advocate. Consumer products advocate? Consumer advocate Lauren Grootman. help them create. They have all kinds of different things. I use a very basic tracking and budgeting template. Mom uses all the bells and whistles. And the cool thing is, whether you have Google Docs or you have Google Sheet rather, or Excel, Tiller works for you. And here's what Tiller does. The one thing Tiller does is allows you to press a button and all of your stuff downloads into your spreadsheet. So if you're somebody that hasn't been using a spreadsheet because of the fact that it's a pain in the butt getting all of that auto population to happen, Tiller's got you there. And if you're somebody on the other side like me that goes, no, I'll just take one of these off-the-shelf apps, Tiller also has you covered there with all of their different templates that you can start out with, so you're not reinventing the wheel. stackingbenjamins.com/Tiller for more there. All right, let's get to our big idea today, because this has been a fun discussion. We started off talking about accident forgiveness and about how car insurance coverages work. We haven't talked about that in a long time, so I thought that was fun. And then second, we went into student loans and a horrible story about student loans and student loan debt. But I think the thing that binds these two together is this. Often in our heads, we have something introduced to us. And this is actually a fact. When companies are trying to get you to buy a new product, they advertise. They put it out in front of you. It's a new idea. It's a new thing. It's a thing that's going to help you better than the old thing would have. Accident forgiveness will help you. Loan forgiveness, rehabilitating your loan, those will help you. In both of these cases, it was a maybe, maybe not, and had more to do with you than it had to do with the company offering it. So you need to do two things. Number one, understand the product and what's being offered, but also knowing yourself. The new way isn't always, and especially in these cases, the new way wasn't always the best way. And I think that's today's takeaway. Thanks a ton for hanging out, everybody in Facebook. Thanks for everybody listening at home. Go Stack some Benjamins. We'll catch you next time back here at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor, and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.